Snap consolidation problem. I've got the roadmap laid out here based on your notes. We've got 5 key steps to hit to get that final statement built. Before we start crunching numbers, do you want to walk through this step by step from the top, or is there a specific working that's tripping you up? You got it. Step by step is the best way to make sure nothing slips through the cracks. We're going to start with the foundation, the group structure. So, looking at your materials, Pop bought 75% of Snap. Since Pop owns more than half, they control it. That means the other 25% belongs to the non-controlling interest, or NCI. The problem states this happened on January 1st, when Snap had a retained earnings balance of $1 million. This is what we call the pre-acquisition equity. Now, let's talk about goodwill. Think of goodwill as the premium Pop paid to buy Snap. It's the difference between what they paid and what Snap was actually worth. Here's the formula from your notes. To find it, we add the consideration, which is the price Pop paid, and the value of the NCI. Then we subtract the net assets of Snap on the day they were bought. Let's trace those numbers. The $6,000 comes from Pop's investment in Snapline in the balance sheet. The $1,500 for NCI is given directly in the activity description. For the net assets, we use Snap's share capital of $4,000 and that $1,000 of retained earnings they had on the day of the sale. Subtract those from the total value, and we get a goodwill of $2,500. Does it make sense why we subtract the $4,000 and $1,000 to find the extra value paid? I see what you're thinking. You're looking at the year-end numbers, but goodwill is like a timestamp from the very first day of the marriage between these two companies. Check this out. We used the $1,000 because that's what Snap had in the bank on January 1st when Pop bought them. The $2,200 you see in the table is what they have now a year later. Also, since your notes use the full goodwill method, we have to include the value of the 25% Pop doesn't own. That's the $1,500 NCI. So the calculation in your notes is $6,000 for the 75% part, plus $1,500 for the 25% part, minus the original equity of $5,000. Does it click why we have to go back in time to that $1,000 figure for the goodwill calculation? I see the confusion. It's tucked away in the text at the very top of the problem. Check the first bullet point in your materials. Even though the table at the bottom shows 2,200, the text tells us they started the year with 1 million, which is 1,000 in the table scale. In accounting, we call that the pre-acquisition retained earnings. Everything Snap earned after that, which is the extra 1,200, gets treated differently later. Does that clear up where that 1,000 came from? It's easy to miss when you're looking at the big table. Perfect. It's always those little sentences at the top that hide the key numbers. Now that we've nailed down goodwill, we need to handle the retained earnings for the whole group. This is working 3. The big idea here is that the Pop Group gets all of Pop's earnings, but only their share of what Snap earned after they were bought. First, let's find out how much Snap actually earned while Pop owned them. We call this post-acquisition earnings. Snap has 2,200 now, and they started with 1,000. So they made $1,200 during the year. Since Pop owns 75%, they get 75% of that growth. We take Pop's original $1,500 from the statement of financial position and add that $900 share. That gives us $2,400 for the final report. Quick check. Why didn't we just add the full 2,200 from Snap's column to Pop's 1,500? Great question. That 1,200 is just the profit Snap made during the year they were owned by Pop. Let's break it down. Think of it like this. If Snap had $2,200 in their piggy bank at the end of December, but they already had $1,000 in there on New Year's Day when Pop bought them, then they must have earned an extra $1,200 during that year. We only care about that $1,200 because that's the part that happened while Pop was the boss. Does that subtraction make sense now? We're just finding the difference between the now and the then. Sweet. Now that we've got that 1,200 down, we have to deal with the NCI, the non-controlling interest. Basically the neighbors who still own 25% of Snap. We need to figure out what their stake is worth at the end of the year. It's their starting value plus their slice of that $1,200 profit we just found. Trace these numbers with me. The 1,500 is from the start of the problem, the fair value of NCI on January 1st. Then, we take 25% of that $1,200 growth, which is $300. Add them up, and the NCI is worth $1,800 on the final statement. We've done all the hard work now. The last step is just putting it all together in one big balance sheet. Ready to see how these pieces fit into the final consolidated statement? All right, let's bring it home. We're going to build the consolidated statement of financial position by combining Pop and Snap's assets and liabilities and plugging in those numbers we just worked out. Check this out. For other assets and liabilities, we just add Pop and Snap's numbers together from the original table. Easy peasy. The key parts are the ones we calculated. Goodwill, the new retained earnings, and the NCI. Also notice the share capital. We only use Pop's 10,000. We never include the subsidiary's share capital in a consolidated report because that's what Pop bought. Everything balances at $22,200. We did it. Does the way we combined the other assets and kept the parent-only share capital make sense to you? Haha! I love the energy. Since we just crushed that problem, here is a quick summary and some flashcards to keep those rules locked in your brain. You're a natural at this accounting stuff. Do you feel ready to move on to another problem? Or should we double check anything on the board? No worries. You totally nailed the pop and snap consolidation today. If you run into any more accounting headaches, you know where to find me. Catch you later.